Thank you, Mr. Chairman. Mr. Bernanke, you made a statement that not raising the debt ceiling was like going out on a spending spree and then not be willing to pay your bill. Were these people on a spending spree drunk and didn't understand that they were eventually going to have to pay it back?
I don't know. The point was that the debt is to pay for tax decisions and spending decisions that the Congress has made and the President has signed and have been already implemented.
Because I know that the debt ceiling was raised in June of 2010 after a spending spree of deficit spending. The Senate has not passed a budget in almost 800 days. We continue to operate our government by a continuing resolution until April of this year. So the people that were in charge of spending this money either didn't care if we had to pay it back or they didn't think we had to pay it back. There's something there. So I agree with your thing that, you know, it's not like paying your debt, but I don't know if the people that are accumulating this debt, what they had in mind for the program. And to me, the people that spent the money and got us into this debt have come up with no solution to how we should fix it. So the people that didn't run the debt up are the ones trying to come up with a solution. But let me ask you another question. You're talking about the housing market. And I come from an area in Georgia that had a lot of new development, a lot of growth. We've had 65 bank failures in Georgia. A lot of those were due from the fact of people being so heavy into commercial real estate acquisition and development and so forth. What's your take on a bank that either received TARP funds or a bank that came in under a loss share agreement, an acquiring bank, and fire sold the assets of either their bank or the bank that they acquired by putting them on an auction, selling them for 30, 40 cents on the dollar. And by doing that, because they had a loss share agreement with the government, or because they had gotten this TARP money, that the community banks that had loans in the same area on real estate, their values were deflated, I mean, knocked down. Homeowners that lived in these subdivisions that had bought these houses, their value was knocked down. They no longer had any equity, not out of any fault of their own, but because the government had given money to banks or entered into loss share agreements for them to come in and to flush these so-called troubled assets away. And so we've had a lot of communities that have immediately, community banks that have had immediately write down these loans and they close them because they don't have the capital. They can't raise the capital reserve. And so do you see a problem with that? And then the last question, I'll give you a chance to answer, on the Neighborhood Reinvestment Act. We just had a situation in my district where a county purchased some homes from a bank that had been foreclosed on, so they got the bank out of the deal. This is federal money that we gave them for the neighborhood revitalization. It's an active neighborhood. It's a fairly new neighborhood. People have just moved in. There are still builders in their building. This county gets the money, goes in, rehabs the houses, and gives anybody that wants to buy one $20,000 for a down payment. It kills the builders. It kills jobs. And so those are three examples of government intervention coming in to try to do something good that has actually destroyed jobs, destroyed wealth, and destroyed communities. I've got counties that don't even have a community bank. Could you kind of explain some of the thinking behind that?
Well, I'm not familiar with those specific cases. I do know that fire sales from failing banks, or from banks that are just trying to get their capital position in better shape, or distressed sales of REO, real estate owned by banks, have brought down prices, have brought down appraisals, and that's one of the reasons that the housing market is weak, because it's hard to get a loan because your house doesn't appraise at the, at the level that you would think it would because of nearby houses which are in distressed condition. So I think that's a major issue, and we need to address that. I think that I didn't quite understand the part about the down payment, but one of the things that's also harming home values is being in neighborhoods with a lot of foreclosed houses around, and I think efforts to rehabilitate neighborhoods and perhaps to convert, if necessary, owned homes to rental homes, or do whatever is necessary to restore the integrity of the neighborhood. That's only going to be good for housing prices if you can do that. So it's really a question of executing these policies in a constructive way.
Thank you.